there's nothing more important. People ask me what they should take in business school, or even if they don't go to business school, what they need to know before getting in business. And I tell them, you have to understand accounting. It's the language. I mean, it's like being in a foreign country without knowing the language if you're in business and you don't understand accounting. So you want to get as comfortable with that as you are with the English language. It's made me a lot of money because I listened to what Ray Dean had to say 53 or 4 years ago, and have been able to understand what I was seeing on pieces of paper, what that told me about businesses, and the limitations of what it told me about businesses. But that's the way we invest. Yesterday I was in Knoxville, Tennessee, and we bought a company. We agreed to buy a company called Clayton Homes about a week ago. It's a big company in the manufactured home business. We agreed to pay $1.7 billion for it. I made that deal over the phone without ever meeting the people there, but I had seen enough through reading 10Ks, 10Qs, annual reports, but looking at figures, what they tell me in terms of the kind of people even running the place, the kind of accounting decisions they make and so on. I was able to make that $1.7 billion transactions over the phone. Yesterday was the first time I met the people, and their board of directors had actually approved the deal a week earlier. So it's, I couldn't have done that if I hadn't have, had a great time at Ray Dean's class 53 years ago. So if I'm going to tout one thing, aside from this particular leadership class, of course, if I'm going to tout one thing, I would tell you that get comfortable with it. It may not happen the first week or the first month in the class, but get very comfortable with accounting.
Let's talk a little bit about the fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. We're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. So when stocks are down, we're going to be buying on balance. And who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers, and that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price, but they have that feeling that they just feel better when stocks are going up. If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like, and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down.
You literally every day have thousands of the major American corporations offered to you at a price, and a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25, and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, swing, you bum.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes.
What is it that you would like to have as your legacy, as you think
Well, I'd
about
like to be the oldest man that ever lived, actually. But no, I like teaching. And so if I've been a decent teacher, and I have a lot of university students come out every year.
And today, is there anything on your bucket list that you would like to do that you haven't done?
I'd have done it. If there's anything I wanted to do, I'd do it. Money has no utility to me. Time has utility to me. But money in terms of making trips or owning more houses or having a boat or something, it has no utility to me whatsoever.
So,
it has a lot of utility to other people, which is the reason for the Giving Pledge.
What motivates you to still run a company when most people your age are playing shuffleboard or they're relaxing or doing something?
Yeah, they spend all week planning their haircut usually. I get to do every day what I love with people that I love. I mean, it doesn't get any better than that.
And so the greatest pleasure in your life, other than doing interviews like this, is what? Looking at new companies, making investments, giving away the money. What gives you the most pleasure? Your grandchildren?
It's all of the above. I mean, but the truth is that I regard Berkshire Hathaway sort of like somebody that a painter regards a painting. The difference being that the canvas is unlimited. So there's no finish line at Berkshire, and it's a game that you can continue to play.
Any word of advice you give to somebody who's a young investor who would like to emulate you, what you would recommend that they do to kind of build something close to what you've done?
I think you should look for the job that you would want to hold if you didn't need a job. I mean, you're probably only going to live once. Shirley MacLaine may differ with that, or a few people, and you don't want to go sleepwalking through life. And whether you make X or 120% of X, it really isn't remotely as important as to whether, in most cases, you marry the right person and you also find something that you would do if you didn't need the money. And I've had that job for 50 or more years, and I was lucky in that I sort of found early on what turned me on that way. But don't settle for something if you can possibly. Don't worry about making the most money this week or next month. I mean, when I offered to work for Ben Graham, I said I'll work for nothing, and I meant it. I mean, just the idea of being turned on. So look for the job that turns you on. Find a passion. Well, I've said in the annual report that I've known maybe a dozen people in my life. And I said there are undoubtedly hundreds or maybe thousands out there, but I've said that I've known personally a dozen where I would have predicted or did predict in a fair number of those 12 cases, I did predict that the person involved would do better than average in investing over a long period of time. And obviously, Charlie is one of those people. So would I pay him? Sure. But would I take financial advisors as a group and pay them 1% with the idea that they would deliver results to me that were better than the S&P 500 by 1%, and thereby leave me breaking even against what I could have done on my own? There's very few. So it's just not a good question to ask whether, I pay Charlie 1%. That's like asking, whether I'd have paid Babe Ruth, 100,000 or whatever it was to come over from the Red Sox to the Yankees. I mean, sure I would have, but there weren't very many people I would have paid 100,000 to in 1919 or whatever it was to come over to the Yankees. So it's a fascinating situation because the problem isn't that the advisors are going to do so terrible. It's just that you have an option available that doesn't cost you anything that is going to do better than they are in aggregate. And it's an interesting question. I mean, if you hire an obstetrician, assuming you need one, they're going to do a better job of delivering the baby than, if the spouse comes in to do it, or if they just pick somebody up off the street. And if you go to a dentist, if you hire a plumber, in all the professions, there is value added by the professionals as a group compared to doing it yourself or just randomly picking laymen. In the investment world, it isn't true. I mean, the active group, the people that are professionals in aggregate, cannot do better than the aggregate of the people who just sit tight. And if you say, well, in the active group there's some person that's terrific, I will agree with you. But the passive people can't all pick that person, and they don't know how to identify him. So
it's even worse than that. The expert who's really good, when he gets more and more money in, he suffers just terrible performance problems.
Yeah.
And so you'll find the person who has a long career at 2 and 20, and if you analyze it, net all the people have lost money, because some of the early people have had a good record, but more money come in later and they lose it. So the investing world is it's a morass of wrong incentives, crazy reporting, and I'd say a fair amount of delusion.
Yeah, if you ask me whether those 12 people I picked would do better than the S&P working with $100 billion, I would answer that probably none of them would. I mean, that would not be their prospective performance. But when I was talking of them, or referencing them, and when they actually worked in practice, they dealt generally with pretty moderate sums. And as the sums grew, their relative advantage diminished. I mean, it's so obvious from history. The example I used in the report, I mean, the guy who made the bet with me, and incidentally, all kinds of people didn't make the bet with me because they knew better than to make the bet with me. There were hundreds, at least a couple hundred underlying hedge funds. These guys were incented to do well. The fund-to-fund manager was incented to pick the best ones they could pick. The guy who made the bet with me was incented to pick the best fund-to-funds. And tons of money, and just with those 5 funds, a lot of money went to pay managers for what was subnormal performance over a long period of time. And it can't be anything but that. And it's an interesting profession when you have tens of thousands or hundreds of thousands of people who are compensated based on selling something that in aggregate can't be true, superior performance. So, but it'll continue, and the best salespeople will tend to attract the most money, and because it's such a big game, people will make huge sums of money, far beyond what they're going to make in medicine or you name it. I mean, repairing the country's infrastructure. I mean, the big money is huge money is in selling people the idea that you can do something magical for them. And if you even have $1 billion fund, and get 2% of it for terrible performance, that's $20 million. In any other field, it would just blow your mind. But people get so used to it, in the field of investment, that it just sort of passes along. And $10 billion, I mean, $200 million fees. We've got 2 guys in the office, that are managing $11 billion. No, they're not. I'm sorry. They're managing $20 billion. Between the 2 of them, $21 billion maybe. We pay them $1 million a year, plus the amount by which they beat the S&P. They have to actually do something to get contingent compensation, which is much more reasonable than 20%. But how many hedge fund managers in the last 40 years have said, I only want to get paid if I do something for you? Unless I actually deliver something beyond what you can get yourself, I don't want to get paid. It just doesn't happen. And it gets back to that line that I've used. But when I asked the guy, how can you, in good conscience, charge 2 and 20? And he said, because I can't get 3 and 30. Any more, Charlie, or we used up our...
I think you've beaten up on them enough.
Yeah, well...